More practice. CSEC accounts. We're going to look at the 2016 CSEC POA Paper 2, Question 1. Alright, so get your papers together and let's go. Alright, question 1 says to us, to prepare a statement of financial position for Lam Jack, who's provided us with some information. And so basically, we want to do that in the order of permanence. All right, so let's examine this question carefully. To do the order of permanence, we need to do a balance sheet. First of all, we need to be able to identify what are our assets and our liabilities and our equity, right? So a balance sheet, we need to know what's the assets, the liabilities, and the equity. So think of it as ginger ale. Right. So what are our assets here? So we got equipment, we got fixtures and fittings, we got inventory, cash, land and buildings, the term deposit, right? That's our money, and the accounts receivable. Right? These are all assets. And we are required to place them in the order of permanence. So in other words, separate them first between, it's classified. Notice it's a classified balance sheet. So we can separate them between non-current and current, and then put them in a permanent order. All right, so what I've done on the answer sheet, right? So let's go over to the answer sheet. Let's bring it properly. I've put in the title that we need, right? Lam Jack. Balance sheet as at December the 31st, 2015. And I've already stated the categories that we're going to need, which is the non-current assets, the current assets that will make for our assets. And then we want the equity, the non-current liabilities, and the current liabilities to maintain that order of permanence. Now I'm going to show you this answer using two methods. So this first one is one, the other one I'm show you using the net asset approach. All right, so let's go. So the non-current assets here I've identified already as land and buildings. So I'm going to put in the figures. So the land and buildings is $250,000. The fixtures and the fittings, which is part obviously of the buildings, right, is $18,000. And the equipment is $130,000. All right, so those added together give us $398,000. Good, so we got the first part of the balance sheet completed. So next we want the current assets, because we want all the assets, right? So we want the current assets, and we can write them again in that order of permanence. So that means we will start with the inventory, and that will be followed by either our accounts receivable or term deposit. You could pick any one, it don't really matter. So I'm going to go with accounts receivable, however, just to maintain the list that we know already. So this will be term deposit. And then, well, the only other asset left there is cash. All right, so I've got all the assets in, and let me put in the values here. So the inventory is $13,500. The receivables are $42,000. The term deposit $5,000, and the cash is $2,100. So that total of the current assets is $24,800, and the total assets is $422,800. So now all we need to do, so we've completed the assets. So we've completed the assets. So now we want the equity and the liabilities, right? Because we're using permanence, the equity will be first. So equity is capital, as we know. All right, so capital. But when I check here, there's no capital. It's not written there. So I mean we gotta find the capital for this business. So we can hold that for the time being and go to the non-current liability. So what's a non-current liability? Any debt obligation that we have more than a year to repay is non-current. So the only thing here that looks like we have more than a year is this loan, because it says only 50,000 is due next year. So that means the rest of it is obviously due later, right? So loan, right? And so if 50,000 is due next year, then if the figure given here is 200,000, then we're gonna have to take away that 50,000, right? So 50,000 from 200,000 will give us 150,000. All right, so that's our non-current liability. Now we want the current liabilities. So the current liabilities will be those obligations which we have less than a year to pay, right? Less than 12 months or 12 months or less. All right, so that order is we usually start with accounts payable, so we can start there. And it says that that loan, that 50,000 is due in March 2016, so that is like 3 months away. So that obviously is current. So what we could do is just to give some clarity is to write down that's what we're referring to, the loan part that is due in 2016. You could write March too, right? And then of course the bank overdraft. All right, so let's put in those figures. Now I want to add it in here so I could get a figure. And I should write this number over here. So let's write that number over there so that I can have all my numbers there. And put this in here so I can add these up and get one figure. So my accounts payable is 42. No, that's not accounts payable. My accounts payable is 61. The loan part that is due is 50,000. And the overdraft is 3700. All right, so we'll notice that the total capital and liabilities must be equal to these added together must be equal to the assets in order for this presentation to be correct. And right now I only have 209,800 as my total capital and liabilities, and that is because I don't have the capital as yet. So I'm gonna have to work out the capital, right? And to find capital is simply assets minus liabilities, right? So assets minus liabilities will give me capital. So therefore, the 209,800 taken from the 422,800 should give me the capital. So subtract, and that is 213,000. All right, so that is the answer to that question using that format. Now, of course, we could have presented it in this format, right? Whereby we use what's called the net asset approach. And what we would have done is we would have taken away the current liabilities from the current assets and get what is known as working capital. And we will add the working capital onto the non-current assets, right? And then subtract the non-current liabilities. So we still got order of permanence, it's just that we're using a slightly different approach. Now when I subtract the non-current liabilities from the non-current assets and the net difference between the current assets and the current liabilities, it will tell me automatically what the equity was, right? So I didn't have to worry about what the equity was, because when I rephrase that statement, it is simply A assets minus liabilities will equal the equity. All right, so automatically I'll get the answer without having to worry about it. So that is also another way you could present it. So remember, in the examination, there's no law to say you have to do the balance sheet A way as opposed to B way, because as long as you follow the correct principles of what is a non-current asset, what is a current asset, what are liabilities, etc., you can present a balance sheet in any format. So thank you, and let's try question 2 next time around, or